Great.
Hey everyone, Albert here from Aleph. Thanks for tuning in for this webinar. Just as a reminder, we are recording this session, so all of you that are here will receive a recording of this in your emails a few hours after we finish. And dynamic-wise, Ryno is going to be the one doing most of the talking here. I'm just here as your host and guiding you through the experience. So if you have any questions as Ryno is presenting, we will take questions as we go. So I will be
Yeah.
keeping an eye on the chat and being the one voicing those questions to Ryno. But yeah, now for the main event, please join me in welcoming Ryno Blignaut. A little bit about Ryno, and why is he very well equipped to talk about this. He started his career at Deloitte, being like a chartered accountant, and then had a very good run as CFO of Xoom, where he went from 30 people, no revenue, into a decade-long journey to IPO and 3 years as a public company before joining PayPal. After that, he was also CFO of Restoration Hardware, a public company worth over $5 billion. And since 2019, he acts as operating partner at Khosla Ventures, who also happens to be an Aleph investor. Ryno, thanks so much for being here. And yeah, we'll love to hear from you about the metrics that matter.
Thanks, Albert. And everybody, thanks for joining us. Just another little bit of context. Even though I'm an operating partner at Khosla, I do go to the investment committees, have done for the last, now almost 6 years. And I do often get involved, obviously, because of my background, I very often get involved in looking at companies' financials, if we invest, before we invest, or if we're doing, follow-ons or pro ratas, or I'm probably, even though I am an accountant by training, I'm not your typical accountant. I would like to think I haven't been an accountant in a long time. So please feel free to make this interactive. I do like to be, not maybe controversial is the wrong word, but I do like to take pretty strong views on the metrics. So I call them simple ground rules, and some of these are obvious, but I think they're important to point out because the context of this, when I first gave this presentation to all the CEOs or a lot of the CEOs at the Khosla Summit this year is, remember, you're running your business. These metrics that matter for you these are not necessarily, there's a nuance between what you might want to put in an investor deck and what you actually want to look at every day. Like this is about running your business, not selling it. So be careful with momentum metrics like ARR, CAGR, MRR. Based on the Aleph customer base, maybe a lot of you guys on the call actually, ARR is appropriate. If you think where ARR came from, and I'll just take a little digression here. If you think where ARR initially came from, it came from the SaaS industry where you have, annual or maybe even 3-year or 2-year signed deals that you then amortize over that period, and when they stack up over time. But then for some reason, over the last 5 years, maybe a little longer, maybe 10, this kind of morphed into everybody using ARR, like even retail companies, like you run a promotion in July, you get a spike in sales, you times that by 12, and that's suddenly your ARR. Well, if you don't run the promotion in August, your ARR suddenly going to drop a lot. So that's why just be careful of these kind of momentum metrics. That's just all they are. They're not momentum. They're just momentum. That they're not the ones paying the bills. Be intellectually honest with yourself. When it comes to things like payback or sales efficiency or contribution margin, which we'll get into a lot. Even if they don't look great today, just have a path of calculating them correctly, and then see where and then a path of how you improve them over time. Like, don't try and make yourself feel better by excluding some expenses or doing something funky to make the number look better. Like that, When you're running your company, there's absolutely no benefit in doing that. And even when you're presenting to VCs, most will just see straight through that, and then you actually lose more credibility versus just showing them the real number, even if it's not that good, versus trying to make the number look better. The third was obvious, don't isolate any metric, like context matters. There's always a trade-off, like whether it's like if you're a fintech, the trade-off between loss rates and conversion in the top of your funnel, for example, matter. It's easy not to lose money, just turn away customers, for example. Like I used to tell Wall Street this all the time when we were public at Xoom. It's like, yeah, I could bring our loss rates down tomorrow. I could just turn away more customers. But in fact, I actually think we should lose more money. And they were like, oh my God. I'm like, well, it's all about optimizing. Be transparent with your team and your board. Remember, they're already investors. Like you don't need to sell to them. Rather tell them what's not working or ask their, input on how can we improve some of these metrics or what would you like to see versus trying to make it. And then the last one here is again, it's obvious. Averages lead to average outcomes. Like things like average CAC is. I'm not saying you necessarily shouldn't calculate it, but average CAC, it's the marginal CAC that matters. Averages are dangerous. So. And this is how I like to think. I always, whether it's your VP finance or it's you yourself or it's a CFO, whatever you call yourself, I actually think I always say that person he or she should be the person who has the business model in their head. Can sit in any meeting and say, hey, I can go run the numbers or we can go follow up, but here's why that's a good idea or not a good idea or why it should work. So remember, accounting P&L, and again, I am an accountant, maybe a bad one. Accounting P&L is an output, not an input. That's not what drives your business. So define your business in a simple equation with key financial and non-financial inputs and outputs, and we'll get to a SaaS example on the next page. Now the various parts, and what's good about that, and I used to do this like Albert said, I was at Xoom for a decade. I used to actually, when we were private for 7 years, do an annual presentation to the company of the business model. Now, maybe half the audience fell asleep, but I think it was important to get across that message, because then the various parts of the organization can focus on optimizing their inputs, and they can kind of see where they fit in. And we can get to some examples on that on the next slide. So, so this is the SaaS or RaaS, robotics as a service or hardware as a service or obviously software as a service. This top piece, that's the formula. It's like your sales and marketing divided by the CAC to acquire a customer. It gives you your new customers times their ACV is your new ARR. And again, I'm happy to use ARR here because SaaS ARR is actually real. It's your new ARR plus your net ARR retention, important, is your ARR divided by some kind of contract amortization, whether you're signing 12-month deals or 2-year deals or 3-year deals, that's your revenue. So now you've got your revenue, times your contribution margin, and we should talk about what goes in there and not non-exact science, is your cash contribution. So, the font's obviously big here, so maybe this is a 1-line or a 2-line formula, but now you can kind of see already, and I've put some examples at the bottom there, but now you can already see the organization saying, okay, well, obviously your sales and marketing organization drives the top of the funnel. Include all expenses related to the teams. Again, be intellectually honest with yourself.
Ryno, one question maybe chiming in that could be interesting. You were talking about your your journey at Xoom.
Yeah.
What would that rough math be over there? Like, what were the key components that you were looking at?
That one was so Xoom was a family remittance business. Good question, Albert. Xoom was a family remittance.
Xoom with an X, right? Like
not the Xoom we're talking about.
I don't want my Spanish accent to mess up and have people think that you're in the video telecommunication space, right now.
No. This was Xoom, this was Xoom with an X, which is a family remittance business. I joined in 2005, so it was a long time ago. It was the first at-scale online alternative to immigrants sending money home via Western Union offline and cash. and it behaved. I call it publicly a quasi-subscription business. And the cohort model I built and the database, everything that I built it was your typical subscription cohort model, which is marketing dollars divided by CAC, new customer, and then there's a cohort curve of customer retention. And it was super sticky. 95% of our business in any month was repeat because if you're an immigrant sending money home, and maybe a lot of you on the call are, or some of you on the call are, you do it every payday, or every month. Like that's how mom back home eats or dad back home eats, like, or pay their rent. Like it's that kind of use case. So Albert, that was that formula. It was, very similar to the sales and marketing divided by CAC, new customer retention,
Nice.
average transaction size per customer times contribution margin.
Yeah,
What's the bottom?
and when you think about that, Ryno, like I'm a big fan of what I call like napkin math. Like if you
Yeah,
cannot fit the math in a
yeah, yeah,
napkin,
exactly.
like it's too
Yeah,
complex, right? So when you were saying
yeah,
this, you're actually saying, hey, you know what? It was like five numbers, right? Like that's the way. It's like, hey, we should just look at five numbers, and
yeah.
again, of course, you have the detail, but it should be that simple, right?
It should be that simple, and it also focuses the organization on, the sales and marketing team understands where they fit in the picture. The product team, understands that, okay, they got to fit into the conversion and the funnel, the retention, and you can even incentivize or track the performance of you could say, okay, if the product team's going to launch XYZ feature, what is that going to do to retention, and what does that do to the math? And everybody understands that simple napkin math. That's actually a great way to describe
Hmm.
it. Versus looking at a accounting P&L. It's just not the way to run the business. So CAC payback period, this is one of the favorite topics that comes up in almost, if not the majority of Khosla investment meetings. There's a simple way to calculate this. Don't try and be cute about it. It's the cash. Like if we spend, $100 on acquiring a new customer, and as I said on the left there, that $100 should be fully loaded. It should include all the costs of the team and the stuff you spend. How long does it take us to get that $100 back? Like literally, just do the spreadsheet. Just say $100 out, month zero, $100 goes out the door. What do I get month one, month two, month three? Things like revenue payback. Like revenue payback's not payback. like, like how much cash did we get at the contribution level to get that to pay back that $100? SaaS magic number, obviously, it's widely used. I'm not a huge fan for that exact reason because it's a revenue. It's a little bit of a momentum revenue indicator. Like you could have a business if you're running at a 90% margin on your revenue or your ARR, then yes, SaaS magic number makes total sense. But if you're like a hardware intensive business or a robotics business that runs at much lower margins, then the magic number doesn't make sense at all. Then the payback on that marketing investment should be at the contribution level, not not at the revenue level.
One,
Revenue,
one question, Ryno,
yeah,
something that we have discussed in the past that I found very, very interesting, and I think you mentioned, but like would love to go a little bit deeper, is what do you mean by marginal CAC payback as opposed to
yeah,
just CAC payback? Because I think it's a
yes.
great distinction.
No, I think thanks for calling that out. It's a super, and you should even try as far as, again, obviously, as you get bigger, as you scale, it's also important to start splitting those into channels, because that's obviously an important, can I port, gas on TV versus online versus this versus that. Um, it's why the marginal is so important is because that's really explains to you, okay, if I raise another $50 million today and the investors say pour on the gas, what am I going to get for that new incremental dollar I'm spending? It's not, and it's dangerous if so if really half your business is coming from word of mouth or something else, and the math just works, at some point that blend breaks. That's why it's so important to be able to know as much as you can.
Yeah.
You know, how can you control, how do you control that math? Otherwise, if that math breaks, you might start, basically just buying revenue at negative margins, which obviously is never a scalable business. So the upside of that is like, if you understand that math perfectly or as much as you can, and it's not that complicated. It's literally like, if you could test, people usually test into this. We used to do it because direct consumer, we used to do this all the time. We had like a 5% of marketing budget was just testing the CAC curve. If I spend, twice as much in this small demographic marketing area and I get so many new customers, how much did I pay for that marginal? And if that is attractive, then pour on the gas. So that's a great call out.
Yeah, and I think that just saying back to you, Ryno, the risk of what you're saying is, yeah, you might have a great, 12-month CAC payback period. When you look into that, it's because you have a lot of like word of mouth that
Yeah,
is like almost like practically zero. But then your actual paid spend, let's say you're spending money in
it's
ads or
24
whatever
months.
it is 24. So like if you're
Yeah.
spending money, you're not getting the 12, you're getting the 24. And that's if you understand
Exactly. That's
that,
the problem.
that's
And
the
then
risk.
especially if you're still relatively small, it's very hard to then say, okay, I can go pour on the gas on the 24-month one because then quickly that average can break and you can go upside down.
One
Um,
one more
yeah,
question here, and I will let you keep going.
yeah, no,
I
no.
think I think like there has been a shift over the last few years. I think uh, CAC payback started to become more popular, and
Hmm.
I feel like 5 years ago I used to hear more about LTV to CAC and like versus the CAC payback. Why do you think is like one is better? Again, the main difference, of course, is like how much you take churn into the
Yeah,
picture and you try to forecast that versus just look at the payback.
another great question. I could do this all day, Albert. Um, LTVs, they my short answer would be they're both important, but I would prioritize CAC and LTV can very easily become and it did become a vanity metric. Like the number of times I meet, and by that I mean, I'll explain what I mean is the number of times I meet like 1 or 2 year old startups that walk into the and in their deck they say, okay, well here's my 10-year customer lifetime value with some big number, and I'm like, dude, you've been around for 18 months, you don't know anything about your customers, like that's, you so uh, obviously, if you've been around for a long time and you have, kind of mature cohort models and you have, good data, that's slightly different. But like, so again, come up with a useful metric. That's why CAC payback is so much more important initially because you're spending real cash and like how long does it take to get that real cash back? Now, the only time when I focus on LTV is when your retention, drop off is fairly quick. So like there's no point. You're not in the business of just getting your money back. So you don't want to be in the business where you might have a great CAC payback, like say 9 months or 12 months, but then the customers, your retention is so low after that that the LTV is almost dies after that.
Yeah.
That is not so exciting either. Like, like I said, you're not this, so LTV is somewhat important, but CAC payback is so much more important. People get so hung up on trying to present some big LTV number that often includes so many non-discounted assumptions that it's almost meaningless.
Yeah,
Uh,
and it goes back a little bit of what you said before of like not isolating any metric and like
yeah,
it's,
exactly. It's
like
all,
they help to be complementary and like paint the
yeah,
full picture.
no, yeah, that absolutely.
All right. I will let you keep
Uh,
going and then we'll go back to some of the questions in the audience.
yeah, yeah, no, absolutely. Revenue recognition. So, for those who you're unfortunate enough to have heard of ASC 606, that's the US revenue recognition standard. It depends what kind of business you run. Sometimes it's simple, sometimes it's not. ASC 606 can get kind of messy. That's why when you're running a business, just use common sense. I mean, I do for internal metrics, like amortize the contract over the period. Like, if your customer signed a 12-month contract, amortize the revenue over the 12 months. ASC 606 sometimes makes it more complicated between when do you install, what pieces you deliver, what that leave that up to your auditors and your accountants to figure out. That's just way too complicated a way to try and run the business. Robotics, for those of you who do hardware, and we'll get to balance sheet in a bit too, if you like having robotics as a service or hardware as a service, obviously your business depends on that capex or that hardware spend. So make sure that's in the kind of like the calculations of payback. It matters. It really matters. And then something called free cash flow should probably be on your P&L, and we'll get to that later on what free cash flow means.
Nice. One question is, you're talking about free cash flow. I think and again, I think like I'm guilty of that, right? As an early stage startup,
Yeah.
What's cash, right? And
Yeah.
and why does it matter? How, you've seen that journey, right? From like 30 people to like public company. Has that changed over time, like the relative importance that you gave to like, some of those metrics, or would you say that, as
No,
a
no,
startup, you would still look at that? Yeah.
that's actually a great call out. And maybe if we jump out to this, and we're going to get back to this, but just in for your, so Xoom, because of what we did there, because of the CAC payback, there were a couple of things in the Xoom model that required cash, and that's very important in your business model. And I could maybe, well, I'll go back. It's very important when you do that napkin, as you now called it, Albert. I love that name. I'm going to start using it. When you do that napkin math, like in a SaaS business, if you're not doing robotics or hardware as a service, if you're doing straight up SaaS, usually 99% of the time, cash, your balance sheet just doesn't matter. Your cash flow is going to be, your revenue minus your expenses. It's going to be your EBITDA, and your EBITDA is going to be close enough to cash. Unless you have some weird dynamic or your customers pay you in arrears, like a long time, like something weird like that going on. Otherwise, your EBITDA is going to be your cash. But like, for example, in the Xoom example, even when we were small, we gave our customers instant access to their money, even if they were in obviously a different time zone like the Philippines or India. So we always had a negative float. And as we got bigger, that negative float just got bigger and bigger. And we ended up, when we went public, on having like $150, $200 million line of credit to fund that float. So that was a key piece of our napkin math, was having to fund that float. So EBITDA for our business, cash flow was not cash flow. EBITDA was very, very far from cash flow. EBITDA, like ours, was EBITDA minus the working capital, plus minus the working capital investments that we needed to make to fund that, that negative float. That was our free cash flow. So that was the cash metric that I tracked, that I reported to the board, because the EBITDA number was not important. And even when we went public, for example, I'm an accountant again. Our GAAP cash flow statement, I used to say this publicly on the earnings release. I'm like, guys, don't look at the GAAP cash flow statement. It's completely irrelevant. Like, it makes no sense. Because depending on the day of the week that the month end fell, our cash balance could swing by like literally hundreds of millions of dollars. And it was just a question of, on Wednesday, that number was low because we didn't have to fund the weekend. And on Friday, it was massive because we had to fund the weekend. So cash, I think I mentioned this earlier. We don't need to go into this detailed example. I'll just put it up here so it's in the thing. But this is what I mentioned earlier about CAC payback. Just do the simple Excel spreadsheet. Month one, you're spending the CAC. If you've got a balance sheet business, you're spending the balance sheet, and then over time you get your cash back. And then, when do you go positive? That's the payback.
Yeah. And I like how simple that is, right? Like, if you, that's really like the napkin math I'm telling you. And so I like the idea of simplicity.
Just because, it's not some weird algorithm or something like that. It's literally just cash. And also, again, be intellectually honest with yourself. Like we had one of our Khosla companies that didn't make it, unfortunately, because they they were a furniture business, they were a rental business that had an obligation that, so firstly, they had to buy the furniture, pay for it to be installed. So that was all like a month one expense, like buy the furniture, pay for it to be installed, and then they got the rental, and then they started going positive, on their kind of payback, on their customer payback cycle. But then they also had an obligation at the end of the contract to go back and take the furniture back out again, which is expensive. So they used to say, oh, we have the short CAC payback, but actually it wasn't because they had these expenses that, that they were legally obliged to go do and later. Um, so you should make a
If they
provision
had
for that.
attended this webinar, if they had attended this webinar back in the day, we might have saved them right now.
Maybe. We briefly touched on this now, so I wouldn't spend much time. Actually, we've touched on all of this. If your balance sheet is often not important as a startup, it really often is not. Like even it's, but when it matters a lot. And in my life, for the last two companies, we had restoration hardware up there. Obviously, restoration hardware, giant furniture retailer. Listed furniture retailer. It matters a lot. Like inventory for us is cash. Like how much, whether we tie up $500 million in inventory or 300 million or $1 billion, it matters a lot. But if you're a SaaS business, like I said earlier, it probably doesn't matter. So don't waste your time on, optimizing for, tracking the balance sheet, optimizing for the balance sheet. Again, be intellectually honest with yourself. If it doesn't matter, it doesn't matter. Everybody uses EBITDA now, even though Xoom is a great example of where it just wasn't the right number. It wasn't the cash needs of the business. It wasn't, and we see this often at Khosla, where we have fintechs come in, like lending businesses that need a balance sheet to lend off. So they say, okay, we're burning X, but then when you look at their cash balance numbers, like, well, then why is the cash, why do you need so much cash? And like, well, where did the cash balance go? It's like, oh, well, we have to put this up as security or restrict this cash, to get debt. Well, that's a cash need. Then you should put that in your free cash flow calculation, and then that's the cash number you should be tracking, not just the burn. Sometimes it could be big, like I said there. There are businesses, Khosla businesses, that don't burn much money, but they need a lot of cash. Cash and other inventory.
Maybe Ryno,
yeah.
one question from the audience before we go into cash, a little bit deeper into cash. So Mitchell here was asking, other than ARR, we need a spicy take here. What's the most overrated metric in 2025? So you said you don't like ARR, you like CAC payback.
I don't mind ARR in real SaaS businesses. The most I'll give you some of my favorites, and I touched on some of them already. Be careful of EBITDA. EBITDA is if you're a balance sheet intensive business, then like EBITDA might just not be the right metric. So do that. Bookings sometimes are really good, but bookings are also misused often. Contracted ARR. Another
our
one.
Go-to-market team would love us to switch to contracted ARR. So yeah. It's not the right one.
Again, it's not a bad metric to track as one of your Salesforce or whatever principles or your funnel. It's not a bad metric to track, but again, be intellectually honest with yourself. Like if there's risk or delays or whatever between contracted and ARR and then revenue, what are other favorites? I hope nobody's doing this, but software capitalization. Oh, I've had a couple of really bad examples of software capitalization the last year, where company showed up, presented financials with no R&D expense. Tech company presented financials with no R&D expense. And I'm like, what? Like, no. And they were like, oh, well, GAAP says we can do this. I'm like, no.
Yeah, do you wanna? I thought that was very. I know it's a little bit ahead of the presentation, but would love you to explain that in a little bit more detail for those of you, for those of like people in the audience that are not following like US GAAP that much and why.
Yeah.
And I remember this story when you told it back then, and I remember saying, "Oh, this is terrible. Like, who would even do it?" But it's the kind of thing that, like, again, if you let yourself be guided too much, but the actual gap accounting, you could fall
Yeah,
into that without even
yeah,
knowing.
exactly. So we can go there. Let me just see. Did we cover I think we covered the balance sheet enough. We can go back to balance sheet, but I think I made the point of if it matters a lot. So then free cash flow becomes important. If it doesn't matter, don't waste your time on the balance sheet. Leah, this is that question. So let's say, how important is gap accounting? I am a chartered accountant. I have a lot of very high level connections in the big four in the US because I've been here for a long time now. It's not. When you're running your business, it's just not. When you're a public company, that changes a little bit. Like you have your quarterly filings, your annual filings, like change a little bit. But when you're a startup, gap accounting is just not important. It's not. Common sense, like appropriate accruals and cash matter just so much more. And I'll go into some of my favorites that I'm sure your auditors are bringing up with you. So I'm going to make sure I go through them. Stock-based compensation. Don't spend cycles on this complex set of accounting assumptions that are all non-cash anyway. Like even as a public company, like the very first thing people do is they back it out. Like available option pool and dilution run rate are much more important. So when you're presenting financials to to your board or to yourself or to your team, just back stock-based compensation out. If it's in there, take it out. You can show it as a separate line, like almost every public company does now, where they have adjusted EBITDA, like non-GAAP adjusted EBITDA, and then you have to by law show the adjustments you make to that number, and one of those numbers are always stock comp by team below. 409A is another one of my pet hates. Like 409A is a US legal requirement. You can't issue stock options without it. Otherwise, the board takes on legal IRS liability. They're all wrong. They're all made up. Like, who knows? Like, company's 2 years old. Like, who really knows? And I love how different auditors argue about different 409As. Like, again, just do like Carter do it. Don't spend too much time on it. Yeah. The lower, the better, obviously. Software capitalization. This is, as as a pre-IPO company, there's just no upside in doing this. This is a US, well, not just US, but international GAAP requirement where, if you're developing software that's going to be useful in the future, you're meant to capitalize some of the hours of the team that developed it and amortize it over the expected useful life of that software. There are so many assumptions in it. I don't know what the exact numbers are, but I want to say even public companies, that number is somewhere between 10 and 15% of their R&D expense actually gets capitalized. It's so much busy work. So the extreme example I was mentioning earlier, I saw where literally a small startup showed up and they didn't have any R&D on their P&L that they presented to the partnership. And I'm like, so you guys are a tech company. How many engineers do you have? And they're like, oh, we have 30 engineers or 40 engineers. I'm like, where's the salaries? Oh, no, it's all on the balance sheet. Oh, and by the way, they didn't put the balance sheet in the deck either. I'm like, no. And it was
for maybe one clarification, Ryno, just to like for people that are not accountants out there, like the rough math here is, if you weren't capitalizing, you would have in your P&L an expense for 100.
Yeah.
Because you're capitalizing, that expense is almost like zero and gets distributed over like many periods into the future.
Yeah.
So you're basically overstating your results by quite a bit for something that is like more, again, accounting that the way that you should actually run your business.
Exactly. If you're sorry, maybe going too fast here. Yeah. If you're spending $100 on your R&D team in the year or the month or whatever, like that is cash that leaves the door. So again, cash is king. That's your burn. The fact that the accounting team might argue that 50 of that should end up on the balance sheet and be amortized over 3 years or 5 years, it's just busy work. You've spent $100. You're gonna run out of money. You're gonna need to raise more money, like whether it's on the balance sheet or not. Like no. We've covered 606 revenue recognition. Just common sense goes a long way versus trying to be fancy about this. And then my personal favorite, which hopefully none of you are going to get into, RH, it was a nightmare. The new lease accounting. statement standard that just came out about 5 years ago, no, actually 4 years ago, where basically any operating lease ends up on the balance sheet and then you amortize it again. We literally at RH put $1 billion of fake assets on the balance sheet overnight, like $1 billion use of, you know, use assets offset by $1 billion of lease liability. So, you know, again, Wall Street said, what should I do? I'm like, just net the two, like just cancel, like just take it off. Like it's just busy accounting. Let's go through this. I think this is important. And then we should do a lot of questions, as many as you want, Albert.
Yeah.
This is my favorite P&L format. And I think this fits almost all businesses. You know, it's a KPI or two at the top that's important to you. Maybe it's three, maybe it's one, but like ARR I picked here again because we're maybe talking to a lot of SaaS businesses. But you know, it could be new customer ads. It could be, you know, in our case it was CAC and new customers or active customers or so that's kind of a key KPI at the top. Then the revenue minus the cost of goods sold is gross profit. Minus other variable costs is contribution margin. And this is important. You know, I think maybe the example I can use here is the RH example is an obvious one. So for example, at RH, our revenue was obviously the furniture we sold. By the way, one of our KPIs we tracked at RH, which Gary, the CEO, calls demand. It's kind of like a bookings number. It's, you know, you buy a couch, it takes 6 weeks for the couch to be delivered. So you're in that bookings number initially, and then obviously we can only recognize the revenue the 6 weeks later when the couch actually gets delivered. So you have the revenue, and then our cost of sales was the product margin, like the actual cost, including the shipping to the US, or if it wasn't in the US already, of that couch and delivery to your house. So that was our gross profit. And then other variable costs might be obvious to you guys, but for us was the stores, the galleries, you know, and that was our contribution margin. And then you got sales and marketing, R&D, G&A, and then you got EBITDA. And then we have these kind of, I would say, optional ones, like we discussed earlier. If the balance sheet is important, these are the two lines you'd want to have: CapEx and working capital. Take it off the EBITDA, and that's your free cash flow. And then I like to always present the cash balance at the bottom, and I specifically called it out here as unrestricted cash. I've seen this movie too many times as well, even just in the 6 years I've been at Khosla, where, again, it's often fintechs, but it's not always, where, you know, people show up and say, hey, we have $10 million cash in the bank. And then like, okay, well then why are you raising money? Oh, but actually 6 million of it is restricted for this debt facility. Well, then you don't really have $6 million, $10 million cash in the bank because you can only use 4 of it. So, you know, so that's why I use that. People often ask about this contribution margin versus gross profit thing. You know, think of contribution as the word suggests, is for every dollar or $100 of revenue you add, and as the business scales, like if you add $1 million of revenue, how much cash do you expect to drop for that to drop down to pay for OpEx, pay for people like you and your accounting team and your R&D team? That is the number what contribution margin is after. So that's the real lever in the business, the real scale that investors like us care a lot about. It's the, if I give you more money, you pour on the gas, how profitable is that number? And that's also the number that you should be calculating things like CAC payback against. Because, you spend this CAC, you get $100 in your revenue, but you have to spend all these costs against that revenue. So that's the number that you want to offset against the CAC when you're calculating your payback. You don't need to overcomplicate it, but things like some of the things people often leave out are, things like customer operations. If if you have an active, maybe now, if you have an active large customer success team or something that supports your customers, obviously they should be in that number. Like, because if you sell twice as many, maybe you're not going to need twice as many of them, but you're probably going to need more of them. Things like, one of my favorite examples is payment processing. I know people often put it in G&A, but if Stripe charges you 3% to sell, if you sell twice as much, you're going to pay twice as many 3%. Like, so that should be in the contribution. So you don't have to be, don't overcomplicate it. People try to be too like fancy about like, oh, but maybe, the head of the team could stay down here and the rest goes up there. Like, just, again, remember, this is about you running your business. You're not trying to impress anybody else. So kind of be intellectually honest about how you think about the business and how you think about scaling your business. But that's all I look at. When I look at financials of companies, I poke at those kind of numbers. I don't poke at the G&A. I don't poke at the R&D, because that's all in your control. Like, what I'm really focused at is trying to figure out, what is the business model now? How's the business model going to improve? What metrics matter in that formula? Because all the other stuff they'll figure themselves out.
And Ryno, when you're now with your KV hat on, as you're looking at companies, and you get presented let's say first version of financials.
Yeah.
How often what you see is what you want versus how often you start like poking around and you see like I wish this was reclassified there. What do you think the state of the art is? Yeah.
I'd say well, let's start with let's start with, unfortunately, the number of companies we see that show up with no financials are pretty bad. Like, so there's that group where you have, no financials. And again, like, if you're raising a seed round and you haven't got financials, then okay, maybe, but you don't have financials. But if you're showing up for like a Series B, trying to raise like 30 million at some valuation, and you don't have financials in your deck, nah, it's not a good reception. And financials are not charged. Financials are like these financials. So there's that group, which I think it's getting better, but there's still some. And then in terms of quality of financials, I think it's mixed. I think people, it's more kind of the bigger problem are more the things I tried pointing out, where it's more they're showing EBITDA. Is that really important, or are we missing something? Or the CAC payback is often a problem. More often than not, people try and make the number look better.
Yeah.
And it's just not important. I'd rather show the real well-calculated number, but they'd say, obviously our margins are going to expand. We're going to get more efficient in this channel. We're going to, and the number will get better. Or as, we're actively adding salespeople as they ramp and get better at what they do. Obviously that number will come down, it'll get better. Versus trying to cherry pick and show a better number. It's just not worth it.
I think
we never spend time. I mean, we never spend time. I would very much encourage people. I hate it. I hate is a strong word, but I actually do kind of get annoyed by it. If people don't split out, another very common way people present financials is just two lines, like costs, which is just two lines, which is like employee costs and then other costs. It's just not useful, because it matters what those employees are doing. So you really want to see, maybe it's not this breakdown, but it usually is this breakdown of sales and marketing, R&D, G&A, and then there's some people in the other variable and gross profit lines, because it matters. Like, it gives us a sense, or it should give yourself a sense, but also gives us a sense of how this business will change over time and how capital intensive it might become or not become if if you have a giant R&D team now, that might be okay. But it's good to know that. It's good to know that they're R&D people and not sales and marketing people, or not G&A people, or not operational people.
I think there's an opportunity, Rhino, for a spin-off series of this. There is Roast My P&L, where people come and present P&Ls to you, and you both here like we have
Well,
the team.
yeah, yeah. No, that'd be fun, but I don't know, maybe not.
We, we, we,
It's things like another example would be, and this happens all the time too, where people try and make the CAC payback look better. So they somewhere in the slides they'll say, "Oh, we have a 6-month CAC payback or a 9-month CAC payback," somewhere in the slides. And then when you get to the financials, they're burning money like crazy. And I'm like, if you have a 6-month or a 9-month CAC payback, you should be throwing off cash like crazy, not 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 burning cash like crazy. Like, and that's often where the conversation or the presentation goes sideways, because like if you're got at the contribution level with those costs, if you have a 6 or a 9-month CAC payback, you're a super profitable company, or you can be, because you're like, think about it, like you're within 6 or 9 months, you're getting all that money back you've spent, so you're generating cash at the contribution level. But then your burn is expanding. Oh, okay, maybe you're adding more R&D, but that's often not the case. It's often just that's often just a very simple look at the financials for 1 minute and say, okay, they've done their CAC payback wrong, because otherwise the numbers just doesn't work.
have you had situations, Rhino, where the metrics look fast? It's like this CAC payback is actually way too good to be true, and maybe without naming, and it was actually true, and you really had, okay, actually I poke at it and it is actually that
Yeah,
exceptional, or yeah.
no, I mean, we do. Yeah, no, you do. No, you do. I mean, one of them was one simple example I can just think of now is we had a medical reimbursement company, where they had to spend the CAC, but then then they had a session then you have a session, or I think they call them sessions with the patient, and then pretty quickly they could get almost 90% of that reimbursed from Cigna or the health providers, the health insurers. So their CAC payback was insanely quick, and it was correctly calculated. It was just very, very good. It does happen. They got some other, and that's actually another example where in that business, LTV was actually more of a challenge than the CAC payback, because it was kind of one of these. They have a session, most of that session's paid for by the healthcare provider, but then the patients dropped off pretty quickly, so you didn't.
Makes sense. Right now, I know we have one more slide with the suggested balance sheet format that we can go pretty quickly, and then we can maybe go to audience questions.
This one is, again, a lot of you for balance sheets. You should obviously have a balance sheet, but for a lot of you, balance sheets might just not be that important. If it is, please present one to yourself, your team, and your investors. This is my favorite example, and of course, not all of this will apply to all of you guys. But unrestricted cash and investments, I spoke about this earlier. That number should be the number that you can use. Restricted cash, maybe you don't have some. If you're a fintech business or a hardware selling business, you probably do. Customer accounts receivable or loan book, if it's important, again, with the loss provision against it. We didn't go into this because I don't think this is a fintech audience necessarily, but if your customers tend to pay you within a month or two, and that this number is not that material, maybe it's just not. Don't waste time tracking it. Inventory, of course, if you're like an RH business, you're selling inventory, it's important. If it's not, it's not. Long-term assets, property, plant, depreciation, accounts payable, deferred revenue. If amortizing revenue, you probably do have that in your SaaS business, where you're amortizing revenue over 12 months or the contract term, or 24 months. Or I like that metric. I think it's an important one, for investors to look at too, because this is kind of, if you think about it, it gives you substance to your ARR. This is revenue that you've already received or it's already, in-house, you're just, for GAAP reasons, you're amortizing it, but it's real. So venture or any other debt, obviously you might have, and then paid in share capital and safes outstanding. This is my favorite. A version of this is my favorite kind of mini balance sheet. Balance sheets can get a lot more complicated, but
Nice.
yeah, let's do some questions. I know we hopped around a lot, but happy to do some more questions.
Yeah. So if just as a reminder, there's a question and answer section. If you can post your questions there, that's the more organized way for us to tackle them. We have Ryno a question from Benjamin here. We're currently raising a pre-seed. We're lending fintech, so definitely up your alley. We're presenting cash flow and main unit economics. What else should we present?
Your pre-seed, you're doing, those are good. I would, by cash flow, make sure I would do a mini balance sheet. And that could just be a simple illustrative, exercise of coming off the cash flow. Obviously, if you're a lending business, your balance sheet, you're gonna have this like loan book I had on my balance sheet or accounts receivable. Just maybe show how you think that's going to move over the next year or two, what that number is going to be, and then how much cash from your balance sheet you're going to need against that book. I think would be good. But I think you're thinking about it the right way. Yeah, that's and when you're doing unit economics, just make sure you have a cost of capital in there. Because obviously you're lending the money out, there's a cost to that money you're lending out. The other thing you might think of doing is, if you're not using debt already to lend out, or if you're not levering up your business yet, you might want to do an illustrative version of, here are the unit economics today, and here's what they could look like if we got some external financing and lever it up, because that actually looks much better usually.
Makes sense. We have another one that is like, if GAAP shouldn't be the guiding principle for startups to make decisions, where should founders go to look at what's those guiding principles? And I think you have a suggestion here for a P&L. Where can people go and learn more and keep double clicking?
That's a good question. A lot of the stuff it's more common sense. Again, GAAP for the most part is fine. So maybe we should turn it around a little bit, saying GAAP's fine. But when the GAAP doesn't make sense to you, when it doesn't seem to fit common sense, rather go with common sense. Maybe that's a better way of explaining it. Like things like the lease accounting I brought up, or the software capitalization, or these kind of weird things, then ignore GAAP. But otherwise, GAAP's fine. GAAP in terms of accruing for expenses, all that stuff, deferred revenue, that's all perfectly fine. Maybe I shouldn't have been so nasty towards GAAP, but that's all good.
We're on the accounting board to get a hold of this recording, and
that's okay. But just don't manage your business to some of these other adjustments to like these things like software cap or things like that. This makes no sense.
We have another question here around how should we think of sharing multiple scenarios with investors?
Oh, love those.
Is there any value?
Great question.
Is there any value of that, or you just want to send one target path?
No, love those. And again, maybe I'm a finance nerd, but no, absolutely love those. Have an aggressive base plan. Obviously, if you're raising money or coming to us, we don't like, big, bold is kind of our tagline. So, have an aggressive base plan. But if you want to have in the appendix, and I would usually put another one in the appendix, like the even higher growth plan, or like if we raise more money, here's what we could do. I love those. Those are awesome. Sometimes people come and obviously raise money for specific reasons, like if we do this acquisition, then XYZ, then then it's also a cool idea. But no, I love it. I wouldn't put like 5 in, but I think to have your kind of aggressive or target base plan, and then have one more, even more aggressive one, or if XYZ happens and we optimize this and that, here's even another one. That's awesome. No, we love that stuff.
I think what along the same notes, there's a question around like, hey, Series B, C is tricky because you have solid unit economics, but at the same time you're making educated guesses on future revenue streams that you might not have any data on.
Yeah.
How would you balance, having that supporting data if you have a core business that is kind of there and you can back up with, we also have new things that we're trying that it's more of an art than a science.
Yeah, another great question. And actually, I think the way I like to present it is, in that KPIs, like for example, if we look at this P&L format, maybe at that top line, ARR, if it's ARR, maybe it's not ARR, but you could have, here's our target plan or our aggressive target plan, and off this future plan, and you don't have to like people. I normally look at most 3-year revenue plan, like 3-year plans. It's don't 5, 6, 7, like at some point, but it's very helpful, and in fact, it's very encouraging if you give us a sense, like maybe at that KPI level, maybe even at some of the other levels on the P&L of like, this is the existing business or existing products or existing line, and here's some of the other stuff we're layering on top. And obviously that's why we're potentially investing. Like we'd like you to layer this other stuff in. So don't be afraid to do that. But if you do have an existing business that's it's already fairly stable with unit economics, that I would call that out and say, hey, well, we have this, and now we're going to layer in on top. And that also, you could also have a couple of slides, or maybe it's one slide of here are the unit economics of the existing business, which is why we're confident on making these assumptions on the new products or new business. You use it kind of as as a reinforcing or a way to give people comfort in this new stuff you're going to launch, because you've already got built a business.
So, Ryno, we're talking a lot about like point in time, forecasts. How often do you think about how often should companies reforecast? Is that, I think there's doing it too much, right? Where you're just haven't learned enough. And then there's also like saying, hey, you know what, we're doing an annual plan, and then we're 6 months in, we're completely off. Yeah. What do you think is the right balance for?
Yeah. So I like to do it. I like to do it this way. Which is you got the current quarter or month, year to date, the full year forecast, which is essentially, okay, obviously now we're in August, so July actuals to date. And then what do we think now with what we know today is going to happen for the rest of the year? And that's your your new full year forecast. It's like a rolling forecast, basically, July actuals, and then what do we think happens for the rest of the year against our initial full year plan. And then this plan versus actuals. So that's how I like to do it. But I think you make a very good point, Albert, which is if you're 3 months in or 6 months in, you're a startup, things change a lot. It's an evolving business. Maybe you've raised more money, maybe you did a RIF, maybe you did some other things. If there's a material change that says, hey, we should make a new plan, make a new plan. And then you start tracking that new plan as the forecast versus plan column. There's no benefit. Again, be intellectually honest with yourself. Sorry, I keep saying that, but it's so important.
Like, the main takeaway. Yeah.
It's like if you're doing a new plan every 3 months, then you're doing something wrong. Like, because then you never had a plan. Like, rather call it a forecast. That's fine. But yeah, if something changes, you hire a new finance team or you hire a new go-to-market team and they want to be more aggressive, or they say the last one was wrong, sure, do a new plan. That's fine. Don't be afraid to do a new plan. That's okay. And by the way, we as investors actually don't care that much about your plans. I know that sounds kind of crazy. It's more it's more important to me. It's so much more important about the trajectory of that napkin math of what is the sales motion, how are those unit economics moving, what cash are we burning. We're just not that time sensitive on, like, we're not public company investors. Like, quarter to quarter, it doesn't matter. Like, we're just, if you miss your plan by a couple of quarters, that's okay. Like, we'd rather have a better business 2 years from now than you trying to optimize to make your plan a year from now.
So Ryan, I think we're on time. There were a couple of questions we might even just answer async or share via email. But thanks so much for taking the time.
Thanks everybody for joining. This is
awesome. Yeah, and thank you everyone. As a reminder, you will get a recording. Ryno, would you mind sharing the slides? There were questions around sharing the slide deck as well. We can maybe put it somewhere for people to download.
Yeah, no, you guys could share that. Absolutely.
All right. Thank you very much.